Hello everyone, my name is Michael Amat. I am the founder of chartyourtrade.com. Our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And the way that we're going to do that today is to talk about when to sell. Now, this will apply if you are trading stocks, commodities, the cryptocurrencies, whatever it is. These methods will apply and will help you exit with a gain or exit before you lose your shirt. So there's two ways that I like to sell. The first has to do with risk management. The second has to do with technical analysis. So let's talk about risk management. The way to exit whatever it is you're trading would be to exit a portion after you've made a multiple of your risk. So let's say you risked $100 on XYZ stock, or you decided to buy Litecoin, Jarek, and you bought Litecoin at about $100 at the beginning of December. And at this point, you've already tripled your money. All right, great. So now that you've made a multiple of the amount that you've risked, so it's not just making $100 on it, you're already at 300, so you've made 3 times the amount that you've risked. Now it's time to take something off and let the rest run, right? So the way that I would do it would be to take off the amount that I've risked. So if I risked 100 or if I've risked 300 and I own 3 Litecoins, then I would sell one of them and then let the rest run. So that way I'm just playing with the house's money. And that's a good way to preserve both your physical capital, right? So now you still have that $300 that you originally started with, and you're also preserving your mental capital, because if it does roll over and go to zero tomorrow with the volatility, it's not out of the realm of possibilities. I don't think that it would go to zero tomorrow, but we've got to be prepared for anything. Then you haven't lost. You haven't lost anything yourself. You still have your initial 300 that you would put in. So preserving that mental capital is so important, because if you watch your investments begin to triple, quadruple, you have 1,000%, and then all of a sudden you have a dramatic crash and you lose not just your gains but what you started with, then that is an incredibly hard pill to swallow. So that's why my recommendation is, once you've made a multiple of the amount that you've risked, then start to scale out of the position. After you make even more, so let's say you're up 500% on something like a Litecoin, then maybe take another piece of it off. And then as it's working its way up, you're scaling out of the position. You're not going to ultimately catch the ultimate peak, but you're scaling out along the way and you're locking in those gains rather than riding it all the way up and riding it all the way back down. And that's how you can really make a lot of money, whether you're trading cryptos or you're trading stocks or ETFs or whatever it happens to be. That's the way that you will protect both your capital, your physical capital, and your mental capital, and be able to compound your way to financial freedom. And that's really the main point too. The main way that everyone makes it in the stock market or trading in general is through compounding their gains. So the way to compound your gains is to not have major losses. So if you're writing it up, you've got to scale out, so that way you're keeping those gains and you could take that capital and put it into something else and begin to compound those gains. And then if it starts to come in on you, then you cut those losses very quickly. But as you're going riding your trends higher and higher, you're scaling out of the position, so that way you're protecting the gains that you have, and you're also allowing yourself to participate in that future upside as well. So scaling out of position is very important, managing your risk is very important, and selling when you have a multiple of what you've risked is very important as well. So if you're risking your entire amount of whatever you put in this example it was Litecoin, but let's say you purchased some call options and you're treating your entire premium at risk, same thing applies. If your expectation is that, okay, whatever I just put in, the entire thing is at risk and that this could go to zero, then you would need to have a 200 to 300% gain before you are taking something off the table. If you're trading a stock and you have a tight stop loss, if you're only risking a couple of percent, 3, 4, 5%, then you would need to have somewhere in the ballpark of a 10 to a 15% gain before you start to think, okay, let me take some of it off the table and lock in those gains and then let the rest of it continue to run. So just different ways to trade and manage risk based off of and sell off of a risk management strategy. Let's talk a little bit about technical analysis too. So the way that you would sell based on technical analysis really boils down to what time frame are you trading. And you would be looking at things like moving averages, you'll be looking at things like trend lines, you'll be looking at things like various support levels. And each of these things appear on daily charts, weekly charts, monthly charts, whatever kind of chart you could pull up. If you're pulling up intraday charts, it's there as well. You just need to figure out what time frames you are considering, and then look at the time frame that you're trading. So let's say you're a swing trader. I swing trade in my personal accounts. So I'm looking at both daily charts, but I'm also looking at weekly charts, and I'm also consulting monthly charts as well, because you want to consider the higher time frames, because that's where the bigger moves are going to be, and you want to make sure that you are trading with the predominant longer term trend. You would also consider where those other moving averages are, where those support levels are, because when time frames begin to converge, that's where you're going to get the most explosive moves, and where you're also going to see the strongest support levels. That's why when you see something like a Twitter that recently consolidated, bottomed, and is beginning to finally break out and begin a bit of an uptrend, you see on the longer term time frames that it broke out and it's moving, and it's pretty clear where it might find resistance. We'll throw some charts up on this video so to demonstrate, but it's pretty clear that you could see where Twitter broke out from longer term chart and where it's going to potentially hit resistance, and it wouldn't be surprising at all to see it start to consolidate again. That's just one example. There's hundreds of examples, and that's basically it on technical analysis. You need to know your time frames, know what time frame you're trading, and then look at the longer term time frames to see where support and resistance will meet or converge. I hope that was helpful for you. If you have any questions at all, please leave them in the comment section below. I will personally answer you. Also, if you found this video helpful, give it a little thumbs up. That really helps us out a lot. And also make sure that you're subscribing to this channel so you get all of our videos. Thanks so much for watching, and I'll see you again in the next video. Take care. Have a great day.